The Fed15 podcast is presented by Serving Those Who Serve, a financial planning practice serving federal government employees and retirees all over the country. This podcast is for informational purposes only and is not intended to be taken as financial advice. All listeners should consult their personal advisors before taking any action. The opinions expressed by our hosts are their own and do not reflect the views, policies, or position of either Raymond James or Serving Those Who Serve. Securities are offered through Raymond James Financial Services, Inc., member FINRA SIPC. Investment advisory services are offered through Raymond James Financial Services Advisors, Inc. Serving Those Who Serve is not a registered broker-dealer and is independent of Raymond James Financial Services, Inc.
Welcome. Fed15 podcast presented by Serving Those Who Serve. Each week, we discuss the latest news and info that Feds need to know in 15 minutes-ish. Sometimes I get wordy or less. So whether you are a seasoned federal employee or just getting started in your career, grab your coffee, your energy drink, your green juice, whatever gets you going. Kick back and we will tell you what you need to know but might have missed. We're your host. I'm Dan Sipe, and we have the amazing, our jewel, Jennifer Meyer, joining us today because Caitlin Murray, where is she, Jen?
I know, we miss her. She is on her honeymoon, which is so exciting. And I don't know if we should say exactly where she is, but it's someplace I am dying to go to.
Yep. And there was a beautiful ceremony, great weather. And so we definitely wish Caitlin well. And Jen, you've done some traveling recently, correct?
I did. I just got back from Europe. I took a quick mother-daughter trip for her spring break. We went to Paris and Rome, and it was amazing. My first time visiting both, and obviously my daughter's first time as well. So great memories, really fun. And I also want to say, so excited for Caitlin. And yes, beautiful weather, beautiful ceremony. So happy for her.
Indeed. Well, we've got some pretty interesting stuff today because I know podcasts are supposed to exist outside of space and time, but we break that rule all the time. I'm like Deadpool. I break the fourth wall all the time. So Jen, you are going to be talking about how to stretch that pension with some smart tax moves. And then I'll be talking about one of my favorite topics, which is the I Fund. And I promise I won't go into a big rant about it. That's been an interesting, what a long, strange trip it's been to quote the Grateful Dead. So Jen, tell us what our feds should be thinking about relative to smart tax moves with the pension.
Absolutely. And I'm so glad to talk about this topic because I talk about it, I feel like a couple times a day, every day with people that I meet with. It is such an important and a lot of feds don't know and they get very stressed out about, how to deal with taxes in retirement. So I'll start with just kind of the basics, right? So let's just start with what is taxable in retirement, right? Because I think that a lot of the confusion starts there, right? So for federal retirees, your FERS pension or your CSRS pension, if you're in the old system, is taxable at the federal level. And there is a small portion of it that is not taxable. And that represents kind of the return of all the contributions that people made over the course of their career. But for the most part, I tell people, just assume it's all taxable. The 1099 you get will delineate the part that's not taxable, but it's a small percentage overall. So your FERS annuity is taxable. Social Security, if you are drawing Social Security, oftentimes will be taxable, not always. But particularly for federal retirees who are getting a pension, oftentimes their Social Security will also be taxable. Traditional TSP withdrawals, and this is a big one for people. I think this is where a lot of people really get lost in the tax world because your traditional TSP withdrawals are fully taxable at the federal level. Also, traditional IRAs. A lot of times people have traditional IRAs. Those are also going to be fully taxable. And if somebody is doing any sort of part-time consulting type work, that income is also going to be taxable. So, there's many things that are going to be taxable at the federal level. At the state level, I always tell people it depends, right? So some states don't have a state income tax and things like that. But if your state does have a state income tax, there's probably going to be a good part of your FERS annuity and TSP withdrawals and all of that will be taxable. I'm going to focus mostly on federal today, but just know that depending on the state you live in, you could also be facing state income taxes in retirement. Okay, so how do we pay our taxes in retirement? There's kind of what we would describe as two levers, if you will. The withholding that they will do on your FERS annuity, and that is something that you do have control over, and estimated estimated tax payments, not necessarily just state, but you can also make estimated federal tax payments. And I would say the majority of retirees that I talk to do a combination of those two things. Not all of them, but many of them. So let's talk first about the FERS annuity. So OPM will withhold on your FERS annuity based on the election you make at retirement on what is called the W-4P form. The thing that I think trips people up sometimes is they think, well, I did that and they're withholding on my FERS annuity, but why do I owe these taxes? Well, because TSP or the FERS and OPM, they don't necessarily know what you're taking out of your TSP. They don't
True.
know if you're doing Roth conversions, which obviously that's a big topic this year. They don't know if your spouse is still working or if you're drawing Social Security. All of those things, OPM has no idea. So OPM is focusing only on your FERS annuity. Now, the big thing with, sort of having some flexibility that a lot of people don't know is you can make adjustments, right? So we just finished tax season. If you owed a lot, you can absolutely have OPM change the withholding, right? Or you can also make estimated state or estimated federal tax payments and state if applicable.
Sure.
So, those are two main ways that people pay taxes. Now, I'm going to give you a very simple way that you can estimate what your withholding should be. And I'm going to focus on the word estimate and simple, because if you really want to get a good number and you really want to know, you really should work with an accountant, right? A CPA, your tax preparer, something like that. But these are steps that, pretty much anybody can do on their own and get a good ballpark estimate, right? So the first thing you want to do is you want to estimate what your annual income will be for the year, right? Take what you expect your gross annuity, and I'm going to emphasize gross because a lot of times people focus on what hits their bank account. You want to focus on the gross amount. Get that number for the year, add in Social Security income that you're receiving, add in expected TSP withdrawals. Some people do it monthly, some people do it on one-offs, but if you have a pretty good idea of what you're taking out, add that in. If you're doing conversions, you got to add that in as well. And you can get a pretty good sense of what your projected income will be for the year. Then the next step, you want to subtract any deductions and credits that you might be eligible for. That'll give you essentially what would be your taxable income. You can take that number and use the IRS website and see where you should be in terms of how much withholding you're doing. And then you look and see, what have you already withheld, right? What did FERS withhold for you? Are you having Social Security withhold for you? Did TSP withhold? Add up everything you've had withheld so far, and now you can get an idea of, are you way ahead? Are you way behind, right? And unfortunately, at least in the first year or two, a lot of times people are way behind. And so that's at that point, you can make adjustments, right? You can make an estimated tax payment at that point, or you can have OPM change your withholding and have them withhold more. The goal, and this is true for all retirees, the goal is you want to have steady cash flow and no surprises, or at least as few surprises as possible, right? Nobody likes to get a big tax bill in April. I'm sure we have people listening right now that, were shocked at their tax bill this year. It happens. I know I talked to somebody the other day that had a really big tax bill because they didn't account for all of these things.
Sure.
You got to do it.
It's easy to do.
Yep. So again, just sort of reinforcing it. How do you make adjustments to your withholding? So you would submit an updated W-4P to OPM. I think you can even do it online via their OPM, annuitant website with FERS. And this is important because a lot of people miss this as well, especially for the first year of retirement. The OPM is not going to withhold state taxes during the adjudication process, right? So once your annuity is fully adjudicated, you can ask them to withhold state taxes and they will, right? But you have to know to go and ask them. And a lot of people find out in April, oops, I forgot to do that. But once your annuity is fully adjudicated, you can then ask OPM to do state tax withholding if necessary. Social Security, that can also be done via the Social Security portal if you are receiving Social Security. And finally, with TSP, and this is a really big one, traditional TSP withdrawals, they will never do state tax withholding. So in that case, you absolutely have to make estimated state tax payments if you're going to owe to the state. And again, states vary, so you have to be careful. You need to know what applies for your state. But again, TSP, they have federal withholding, but you can tell them, if you want more withheld, you can request to have more withheld and they'll do that. It doesn't have to be estimated payments. Okay, so then let's talk about ways to plan strategically for this, right? So a couple things that I give people suggestions on, and, we're still pretty early in the year, sort of mid-year, but if somebody's planning on making a big TSP withdrawal, one way to manage your taxes in that case might be to wait until close to the end of the year and take part of that withdrawal at the end of the year, and then maybe make the rest of it early the next year, right? And it doesn't have to be the end of the year and early next year, right? But the point is you plan out if you're planning to make big TSP withdrawals. Because the last thing you want to have happen, and this happens all the time, is somebody takes a big TSP withdrawal and it bumps them into a higher tax bracket, right? And that's really what you want to avoid no matter what. The other thing I would say is notice at tax time, notice the amount, right? So if you get a big amount back, you might be having too much withheld. And if you end up owing a lot, you probably need to adjust the ongoing withholding, right? Bottom line, when it comes to taxes, you absolutely can plan around it. It doesn't have to be a guessing game. So hopefully that'll give some people some help on that front. Again, it's something that I feel like I'm talking about every day with people. So.
Sure. And Jen, it's great to have you in this venue because we say this a lot here. And you may not feel you need a planner, but you still need a plan.
Yes.
And so it's really great to have you with your boots on the ground experience talking about this so that all our feds. So folks, share this one. Let's get this one all the way around the world because some of those under withholding penalties are no joke.
That is very true.
So by all means, share this with your friends. Okay, so let's talk about the I Fund.
This is your favorite. I know you love this topic.
It really is. And if you've attended any of the webinars that I've presented on it, I call it the problem child. Because when it came in 2001, its selected index was the MSCI EFA index, Morgan Stanley Capital Investment EFA index, which is Europe, Australasia, which I didn't even know was a word, and Far East index. So essentially it was Europe, Japan, Australia, New Zealand, which was a great index back in the 80s. And by the 90s, it was already kind of out of date. But it came in the 2000s, and one of the things that happened in the early 2000s was the lost decade for the S&P 500. So from 2000 to 2008, the fund did really, really well. Then it was reviewed for an upgrade to more accurately represent the total international holding community. And in 2024, that went through. I'm not going to go through all of the skullduggery and palace intrigue that went into the change. Check out one of our webinars. I tell the story. Happy to do it. Not going to burn time here. So let's talk a little bit about the I Fund. I like to say, in this case, I stands for incomplete because its index is the MSCI, Morgan Stanley Capital Investment, world minus the US, minus China, minus Hong Kong. Now, if you're sitting there looking at this saying, one of these is not like the other ones, you're absolutely correct. I do not have a good reason for why taking China out of an international index makes it more interesting. But moving past that, it is still a massive improvement in how much of the world it covers. So what this allows you to do is invest in markets outside of the US market. And why is that important? All markets don't move the same all the time. So let's go back to the lost decade for the S&P 500. We had the tech boom, the bubble burst, and S&P was pretty much flat to slightly negative for a decade. Well, again, 2000 through 2008, 2008 knocked the stuffing out of everything. But during that period, international funds did exceedingly well. The I Fund was a great performer. And some of you right now are saying, well, Dan, I Fund was the number one fund last year, so I moved all my money into it. Don't do that one either. What we want you to do is consider being represented in all of the various asset classes, which would be U.S. large stocks, U.S. small stocks, international stocks. And that's what you get with the I Fund. So it's meant to be a sleeve, not the standalone portfolio. And sure as you're born, Jen, Caitlin, and I were doing a TSP webinar, and somebody put in the questions, I wish I had known about I Fund sooner because I moved all my money into it. And it's like, no, don't do all. Don't do all. Make it some. Okay. Yeah. And why is it important to do that? Because again, not everything wins or loses at the same time, typically.
Right.
Okay. Now, past performance is not predictive. And if you saw I Fund did great this year and you moved all your money into it, you probably want to rethink and want to have a mix of C, S, I, F, G, across all of them. So a couple of things to understand about it. There is risk to the I Fund that's a little bit different. So currency fluctuation can impact the returns. There will be periods where US outperforms and international lags and vice versa. But the main challenge in all cases is to stay invested during underperformance, because that's when you're really going to earn your returns long term. Because if you're staying invested, you're probably adding money during that time too. And that's very important. So don't add extra money after strong performance. Don't cut money going into it after it has lagged. One of the best ways to decide your allocation is to get understanding of your risk tolerance. We have tools on the site to help you with that. And you need to balance between your need for growth and need for stability. One of our experiences is people get entirely too conservative, heading towards retirement. Number one question I've gotten over the years, I'm retiring this year. Should I move everything into G? And my answer is always the same. Are you going to spend it all next year? Because if you are, maybe, yep. Not even definitely, maybe. So don't sleep on the I Fund. It is massively improved. If you want to hear me rant about it, check out our webinar and I'll tell you the whole story about how we got to taking China and the US out of it. But it is still a massively improved one, and it is part of a healthy allocation overall. So if you take nothing away from this, take that.
Yeah, absolutely. The I Fund is such a hot topic these days. And like you said, it's not all or nothing at any point in time in any one of the funds. So, all right. I think that's it for today, right?
You are correct. I'm always sad when this happens. No, we can't be done already.
I know. Well, the good news, Dan, is I'm back next week as well.
Yes, you are.
So you get me 2 weeks in a row, and obviously happy to be here. Missing Caitlin, of course, but I hope she's having a great time. We'll be back, next week's topics. I'm not sure what they are off the top of my head, but I know they'll be great.
Yep, this is all part of the updates you need to make informed decisions as a Fed. Be sure to subscribe to our podcast on this, because it helps us amplify the signal and it helps you get the information as fast as we have it. Please remember to share it with your friends and colleagues.
Absolutely.
For more information on the topics we covered in today's show and more, check out our blog on the website, stwserve.com, and be sure to subscribe to our newsletter, The Weekly Serving, and we will ship our latest to you when we do that. And also, never forget our weekly webinars.
That's what
we've got them every single week. Yep.
Yeah.
And Jen, do you have some recommendations there?
So upcoming webinars, we have, let's see, the Social Security, that one might already be gone, but FEHB is May 12th, and TSP planning, where you're going to talk about the I Fund, that'll be coming up on May 20th. So definitely pay attention to that if you want to learn more about the I Fund discussion.
Absolutely. And if you prefer more of a one-on-one approach, hit us up at meetings@stwserve.com. We're happy to spend time with you and walk you through any way we can.
All right. Well, thanks, everyone. Thanks, Dan. It was great.
So thanks again, folks, listening to Fed15. I'm Dan Sight.
And I'm Jen Meyer.
And we will see you next week.